Treasury yields were muted the day after FOMC, after the Fed came in, cut rates, and sort of took a little bit of the wind out of the sails. Given the struggles and the stresses in the front end of the curve, we didn't see a whole lot of market movement today in the 10-year bucket, given the fact, I think that right now the Fed has given its outlook as, yeah, we're going to cut rates yesterday, and now we're going to wait and watch. And it was more of a hawkish tone than most expected as far as giving clarity. And when we talked about this being one of those it moments of the year, we were hoping they were going to give us some better forward guidance that would tell us when or when not they weren't going to be cutting rates or possibly leaving them alone or possibly even looking at raising rates down the road. What we got was, I think, a very mixed message. And the market does not like mixed messages. And today we saw yields decline just slightly, but with a recent low of 142 and a recent high of close to 190, we're somewhere right in the middle there. So we really didn't get a whole real directional push from the Fed. Again, it's only been one day, but ultimately I think right now the market needs some clarity, and we might get that from the Fed at the next meeting, but that's not until October. So we have some time to absorb what they've done or haven't done, I guess, as you want to put it, until that time. Now, if we look at market volatility, we saw a big bit in volatility heading into the Fed meeting as expected, because we weren't sure if how clear they were going to be about which way the market was going to go, and really not giving us a whole lot. We saw volatility decline very quickly, but it does remain elevated because a lot of the questions that weren't answered remain out there. And I think at this point, if we're looking at 10 years going back to 142 or back to 190, I think we're going to hover in the middle, and it could become more of a fundamental play based on economics and based on what we're seeing now out of China and the U.S., based on struggles and geopolitical risks in the Middle East. There's a lot of what ifs, as well as a big position shift. We saw a lot of longs get out of the market on that sell-off, and now they might be scrambling to get back in as the flight to quality bid, while it isn't as apparent as it was, say, going back several months ago, it is still coming back. We are seeing buyers come back in, just not as aggressively. So at this point, the market changes its focus from Fed policy, I think, back over to China and U.S. trade. That certainly hasn't gotten resolved yet. What's going to happen with Brexit at the end of October? That hasn't been resolved yet. And certainly when we hear about global growth expectations being lowered, that has to raise a few eyebrows. In the U.S. right now, we're still seeing I'd say moderate to better economic growth, but we're not out of the woods yet, and certainly wouldn't be immune to any global growth decline. So right now, 10-year note yields hovering near the midpoint of the recent range, but likely leaning back towards going towards the lows unless we get some shift in economic policy and the U.S. and China can figure it out.